Good morning, everybody. We are broadcasting here from Barcelona. I would like to welcome you all for this first Euro-Mediterranean Economist Association webinar in 2021 on the sustainable bank business models for post-COVID-19 recovery in Europe, Mediterranean, and Africa. The sustainability of bank business models is becoming priority for banks' leadership, policymakers, regulators, the economy, and the society as a whole. Banks are very important key actors in the economy. They channel savings for productive investments and are essential players to sustain growth. They must also contribute to public interests. During the global COVID-19 pandemic, they were and they are still the channel of transmission of public guarantees, state aids, to mitigate the disastrous effects of the pandemic on the economy and on the society as a whole. Many have even qualified banks as part of the solution in this crisis, not part of the problem, as was the case in 2007, 2008 global financial crisis. Now, will this qualification continue if the state aids and all the public aid that has been granted to them, also the relaxed regulatory measures are lifted? Or will these measures and government support become the norm? Banks must be sound and stable by maintaining strong capital positions to face increasing credit losses, being profitable and efficient, contributing to the greening of the economy also, and also combating crime and terrorism. Also, it is important to consider that the environment of banks and financial institutions in general is changing very rapidly because of the current digital transformations, and then also what is going on in the society because of the global pandemic that we are living today. At the Euro-Mediterranean Economists Association and with all its partners, the Center for European Policy Studies, the Business School, former Casu, and LUMSA, we are all continuing to co-develop research and knowledge on bank business models under the Bank Business Model Initiative, which was launched as early as 2010. So just this initiative aims to assess, to understand bank business models in their environment, actually changing environment. And also what we're trying to do is to enhance knowledge on this topic by publishing a yearly bank business model monitor. Since 2015, we've been doing this exercise with our partners for Europe, mainly because the data, it's more or less available. And also we are currently developing this database that to include Middle East countries and Africa. Also, new research that we are conducting with the teams will be also examining the sustainability factors, and all work, again, and I repeat, is publicly accessible, available, and we will be shared with all the academics, also the data, in case they are interested to develop further their research. Moreover, we are also developing together with the business school, the Center for Banking Research at the City University of London, a new initiative which we have already launched last year, but now we are launching the public website, which is a joint initiative on bank conduct risk for Europe. And we are aiming at enhancing this database over time, and also enhance our research for the Mediterranean and African countries. This initiative aims to foster transparency in financial activity and also to deliver a category of benchmarking which comprises a level of conduct cost and also the conduct risk of banks. It is an analytical tool for banks and their stakeholders. And also, perhaps later on, Barbara and Doriana will say more about it. So all these elements will guide our discussion today from now to 5 o'clock in the afternoon. And today, I'm very much honored to welcome this lineup of distinguished panelists and colleagues, all working from different perspectives on banking and financial issues. So let me say a few words before we start. This webinar content and discussions are fully public and live broadcasted on Facebook. EMEA team will later on publish the recording of the webinar and the report that summarizes the main discussion points. For all participants who are joining us today in this webinar, please write your questions and comments on the Q&A box and the chat box that you have. So these are the main requests. And also, please, if you do not talk, switch off your micros. So let us start. The objective of this webinar is to delve into sustainability and sustainable bank business models for post-COVID-19 recovery in Europe, the Mediterranean, and in Africa, based on different perspectives. We will discuss the conditions for banks to exit the exceptional regulatory environment they are in today, and also to examine the factors of sustainability and, if possible, resilience of bank business models amidst the transformations the economies are experiencing. First of all, I will start our discussion by inviting Professor Barbara Casu. So Barbara, she's the director of the Center of Banking Research at the Business School, former Casu, in London. Barbara is also the director of the Casu Executive PhD program. She has worked extensively and published widely on banking, financial regulation, financial innovation, corporate governance. She has a lot of publications on these elements, and I'm very happy to have Barbara with us to share some of the research we are also doing together. And Barbara, the screen is yours. Thank you.
Thank you, Ring. Thank you for this very kind introduction. And it is a little bit difficult to introduce me at present because the business school does not have a name, but we are in the process of changing the name, and the new name will be announced on April 21st. So if you invite me again later on in the spring, the business school will have a name. Let me just start my presentation, please, next slide, by making a quick distinction between sustainable banking and bank sustainability. Sustainable banking, in broad terms, is the integration of ESG principle, environmental, social, and governance principle, into investment decision that the bank takes to benefit not only the bank shareholders, but a broader set of stakeholders and society. This is very important, but is not what my broad overview presentation is going to talk about. What I am going to concentrate on instead is bank sustainability, which involves the rethinking of current business models to meet the changing expectations of regulators, changing expectations of investors, and importantly, the changing expectations of customers in a way that banks continue to be profitable, because bank profitability is a key to bank sustainability. Next. To do this, I will focus on three main challenges that banks in Europe in particular have been facing since the global financial crisis and the Eurozone crisis, which is the increasingly tight regulation that has been imposed on them post-crisis, the increased regulatory scrutiny, and the increased competition from non-bank financial institutions, including fintech and big tech companies. And all these three challenges are important challenges, and they have been developing in the background of a rather weak economic growth environment. The economic growth in Europe has been sluggish for the last 10 years, and this has put a further strain by the current COVID crisis that is going to impact on an already low economic growth. There were some new data published today that said the overall GDP is about 22% point below the projected trajectory in 2008. So that has been quite a big loss in terms of economic growth. Next. So the first of the key challenges is the post-crisis regulatory environment. I do not have time to cover this in details. I know all of you will be aware of the increasing capital and liquidity requirement under the various Basel's framework and all the changing and more comprehensive rules, the opening up to competition from new sectors, for example, under PSD2, and the tightening of rules on trading, for example, under MiFID. As a result, European banks are better capitalized than they were in 2007. Nevertheless, profitability remains low, particularly compared to their US peers. Return on asset, return on equity, and net interest margins are low, and the stock of non-performing loans is still high in some countries and is also likely to increase when the government support that Rim was talking about will inevitably end. Next. The question here is, should we care about banks' profitability? In this slide, you will see some recent statistics from the European Central Bank on banks' return on equity and return on assets. And these are deteriorating and quite sluggish. And on average, European banks are still not doing too well in terms of efficiency and cost-to-income ratio. So why should we care about banks' profitability? Because a healthy banking sector is better able to absorb shocks and is better able to continue in its key intermediation role. An unprofitable banking sector is by definition a weak banking sector. Unprofitable banks struggle to raise capital, struggle to attract customers and investors, have fewer resources to invest in R&D, are more likely to need state aid. And as a conclusion, I will argue that profitability matters for the sustainability of bank business models. Next, the next challenge I want to briefly talk about is the increased regulatory scrutiny. Post-crisis, we have seen a number of scandals and fraud episodes that have led to the largest European banks being hit with an unprecedented number of misconduct fines. These fines relate to episodes of money laundering, economic sanction violation, the manipulation of financial markets. Let's think, for example, about the LIBOR scandals or the fixing of foreign exchange, various mis-selling scandals, and tax and accounting violations. The conduct cost project that we are running at the business school is collecting all these misconduct costs in detail to have a better view of the conduct risk of banks. And as we see, is not only the conduct costs in their manifestation as fines, but also the increased provisioning that banks have had to do for conduct risk that have been increasingly important. And again, conduct risk management matters for bank sustainability. Next, the final challenge I want to talk about, and I think is a very important challenge that we need all to be aware of, is the challenge from non-bank financial institutions. And as banks have been struggling in the past 10 years since the crisis, non-bank financial institutions have been thriving. From the graph from the Financial Stability Board, what we can see is that after a decrease at the height of the crisis, the global assets of non-bank financial institutions has been increasing regularly. And at the moment, they account for about 50% of global financial assets. Banks remain the largest sector in many countries, particularly in particularly in emerging markets, but the importance of non-bank financial institutions is growing in most countries. So what type of institution am I talking about here? Non-bank financial institution is an all-encompassing term that includes both small fintechs offering innovative solution in the payment space to larger entities, for example, money market funds operating on capital markets. Next, and the question is why is this relevant? Let's take, for example, a look at the retail market that is important for regulators. Post-crisis, this tightening of regulatory rules has meant that banks' lending behavior has shifted towards safer lending. And what we have witnessed is that non-bank financial institutions have picked up the excess demand for credit, and they have been giving credit both to households and particularly to small and medium-sized enterprises. And they did so by leveraging new technologies, which has allowed them to offer traditional banking services in a new way that is faster, that is cheaper, that is more appealing to customers. And in this way, they have been able to compete with banks not only on price, but particularly non-price competition. In this context, think, for example, about the growth of digital-only banks, peer-to-peer lending, and various platforms for online lending. This is relevant because the COVID-19 pandemic has accelerated the digitization of financial services in many countries, and the speed of change is very important. The pandemic has really accelerated the speed of change towards more digital services, so it is increasingly important that banks adapt their business models to this change. Next. But what I really want to draw your attention on is the entry of big tech firms in financial services. Big tech firms like Google, Amazon, Facebook, and Apple, and their Chinese counterparts, Baidu, Alibaba, and Tencent, have been playing an increasingly important role in the provision of financial services. And unlike banks and other sectors, they have actually been benefiting from the pandemic. Amazon's profit boomed during the pandemic because everyone was buying online. So these companies benefit from large asset size, large existing customer bases, from the ability of collecting and analyzing data, which used to be a unique selling point of banks. And unlike fintechs, they can scale rapidly across business line, they have considerable resources, and sometimes they can access funding even more cheaply than banks. Next. To give you an idea of their size, in the next slide, I am showing you the market capitalization of the big tech companies and the largest financial groups. So some of the world's largest banks, the G-SIFIs, let's say, for example, JP Morgan or the Bank of America, they are not even as big as Facebook, or they are not even as big as Alibaba. So that gives you an idea of the power of these big tech giants. But it's not only the size. The next slide gives you an idea of the profitability of these corporations. So we discussed earlier the importance of bank profitability for sustainability. And if we look at the average returns, average return on equity of the G-SIBs banks in recent years, they average at around 7%. The average return on equity of the big tech companies average at over 30%. So that is a massive challenge for banks. And that is important. And what is important is the way they have been accessing and offering financial services. Next slide. Particularly in some emerging markets, whereas a lot of the innovation that is happening in Europe and in the United States is coming from fintech companies, and fintech companies still have a scalability problems. They don't have the size. Sometimes they struggle to raise the capital. Big companies have been moving and offering financial services in a lot of developing markets. Next. This can have some benefits because there is a potential for innovation. There is a potential for financial inclusion in some markets. For example, we have seen what happened in Kenya and in India with the telecom companies and M-Pesa, and it can facilitate access to finance for small and medium-sized enterprises. But of course, there are risks, similar risks to banks, but also of other types of risks. For example, governance shortcomings, that is very important for ESG. These companies are not regulated in the same way as banks. Plus, there are risks that derive from their network, their infrastructure. So the question is, how will this affect banks and bank business models and business model sustainability? And in my next slide, I have been looking at the comparative advantages of banks, fintech companies, and the big tech in terms of size, for example, brand recognition, customer loyalty, global customer base, and their ability to raise funds, their ability to invest, for example, in R&D and in cutting-edge technology, their ability to exploit economies of scale and cross-subsidize because they have a broad set of subsidiaries and products. And then I have looked at the regulation. So banks are not to be written off yet. They still have a lot of advantages. They have two key disadvantages here. The first is most banks are not operating at the cutting edge technology. A lot of banks are still plagued by legacy infrastructure and an IT structure that was built in the 70s and 80s. So they will have to really invest a lot to upskill their infrastructure. And then they have a massive regulatory burden. Sorry, that was my timer finishing. And I am done on time. But the thing that I want to finally draw your attention to is the big tech companies. And the big tech companies, I have only managed to put a question mark on customer loyalty. Their competitive advantages are very strong. So on my last slide, to conclude this for you, the impact, next slide. The impact on bank business models is important. The arrival of fintech and big tech companies really poses some important challenges for bank sustainability, particularly if banks start losing market share in very profitable market segments like retail and consumer credit. Banks might change their business model, might modernize their IT infrastructure, might try to digitize their provision, develop their own platform, but that takes time and is costly. Other ways that we can see this evolving is partnership with fintech, or sometimes partnering with big tech platforms in different market segments. And this could lead to financial services becoming more specialized and more modularized. Think about Apple Pay through your bank on your mobile phone. So a kind of plug and play services. But these type of joint venture and new business models raise issues for policymakers because the risks of fintech and big techs are very different from those of banks. And in particular with big tech companies, the fact that they are so big and they have very diverse line of business, they are complex institutions, and they can have very complex interlinkages with financial institution, can also be a new source of systemic risk. Thank you.
Thank you very much, Barbara, for this very interesting introduction. I have one question to you, which clearly you mentioned the fintech and big tech, who are not only gaining a lot of traction in financial services, but also they are not as regulated as the banking institutions. So how do you see this as a, in terms of enhancing or maybe changing the whole concept of banking and financial services in the economy? How do you see that going forward?
The regulation of banks is important because of the risk to systemic stability. And we know that this is one of the key risks and is one of the lessons from the global financial crisis. But what bankers are complaining, and I know we have a representative coming on later, is that they are so heavily regulated and restricted in the activities that they can do, that they are starting to propose that regulation should be by activity rather than by type of intermediary. So if I am a big tech company, if I am Google or Amazon, but I am offering banking services, I am offering credit, I am offering loans, then in that respect, some of my activities should be regulated akin to banking, because otherwise they have really an unfair competitive advantage.
Thank you very much, Barbara. And I would like to move straight away to the next panelist. I would like to introduce Professor Giovanni Ferri. Giovanni is a professor in LUMSA University, and then he is also the founder of Sustinentes. Sustinentes, you can say a few words about it afterward, but this is really an institution that is dealing with sustainability at all levels of the economy. He's also the founder and chair of the Center for Relationship Banking and Economics. And this center is trying to foster research to better understand the relational goods to promote societal well-being, and also to ensure that banking are serving the society and the economy. He's also the founder and chair of the Master in Management of Sustainable Development Goals in LUMSA. Giovanni has published widely on financial shocks, banking structures, rating agencies, corporate governance, internationalization, Chinese economy, and so on. So we are very happy to have you with us today, Giovanni, to give us some views on sustainability in banking, and how do you see this going forward. The floor is yours.
Thank you very much. I am going to talk about business models, and I would like to see my presentation on. Can somebody do that? Okay, thank you. Next slide, please. In particular, I would like to restart following on what Barbara was saying before me. Some of the key challenges that you will find here are the same to bank business models, but I will consider also the opportunity side, and the opportunity that I see for banks and the financial sector is in sustainable finance. Sustainable finance, we will see that can be the true game changer in moving banks from seeking short-term profits to another frame of mind where they are instrumental to create long-term value. Even in this rosy perspective, of course, there are some challenges, and I will see. I will outline some challenges based on insiders' view, challenges for banks to move to sustainable finance, and I will also list some challenges based on views from the ESG industry, where ESG is the rating that is normally used in sustainable finance, and it stands for environmental, social, governance. And finally, I will try to conclude on whether the traditional bank business models that we have inherited from the past and that seemed rather out of fashion might have some value in this role in the transition to sustainable finance. Next slide, please. There are three key challenges that are not alternative, but somehow overlap with what Barbara said for banks nowadays. One is the rather unfriendly stance of regulation, which at least particularly in Europe seems to favor market finance over banking finance. And also, there does not seem to be a kind of appreciation for banking diversity, but that is a separate story. The second is fast digitization of finance, and this intensifies fierce competition by non-banking firms, both fintech and the big tech particularly, which are mostly exempt from much of the regulatory burden that banks have instead to withstand. And also digitization seems to be favoring market finance over banking finance. Third, but not last but not least, unfavorable monetary policy, which keeps the interest rates at or below zero, and this has very negative consequences for banks' ability to make revenue from interest margins, and that, particularly in traditional banking business models, require either you come up with some more fee income, or you have to cut jobs, and it is cutting jobs, cutting branches means changing your business model and the way you relate with your customers. Next slide, please. The good news in the next slide, please, is that there is also an opportunity, and the opportunity is sustainable finance. Here, Europe is for once the epicenter of the change, but it is not only Europe that is moving this way. Certainly, Europe is moving more convincingly towards a sustainable transition. And the accelerated transition to a more sustainable development model, like it is mandated in the European Green Deal, stipulates that banking and finance must play a role of pivot. In the case of Europe, for instance, the European Investment Bank is supposed to become a climate bank by 2050. And this seems to be, this evolution seems to provide an opportunity also for traditional banks for three main reasons. First, because regulation seems to be moving towards an introduction of a green supporting factor, as it was advocated already in the action plan on sustainable finance by the European Union. Second, at an overall, a macro level, the European Central Bank stated relatively recently that, and strongly, that climate risks should be factored in within the monetary policy framework, and the European Central Bank also backs the evolution of the green bond market and of other sustainable finance market segments. Third, and this may be some value added from my small presentation, there are issues with the ESG ratings that I already mentioned, are the drivers that are providing orientation for sustainable asset managers and in the allocation across the sustainable finance markets. And these issues with the ESG ratings and the fact that they cannot provide an orientation on smaller size firms, and the lack of adequate non-financial reporting by the vast majority of the enterprises in society, require the production of additional information to certify green status. And this provides a potential opportunity to use banks' proprietary information, particularly on the small side, small SME lending could be very valuable. Next slide, please. Here, let's look back at what was the situation after Lehman and the global financial crisis. I'm sure you all remember that the people on the main street perceived the bankers as greedy and myopic, and a new word was coined, the banksters, that was mediating between bankers and gangsters. Now, 10 years after that, there has been multi-level remedial actions that have brought banks to safer shores. There has been in-depth regulatory review overall, I would say. Best business practices have been introduced in banking. And also, there were significant investments that were made on educating customers in terms of financial education. So today, the transition to sustainable development is the true emergency, and it requires a revolution of mentality in finance must change from greedy and oriented towards short-term profit to responsible and oriented to long-term value creation. It is a kind of metamorphosis, as we sometimes see in nature. The financial sector is responding by promoting sustainable finance, which is an entirely new segment devoted to supporting the green transition. And sustainable finance raises challenges as well that may be solved partly by using the competences and the information at traditional banks, so their business models. Next slide, please. This is the first challenge. I'm referring to a very recent publication by the European, the EBF, European Banking Federation, and UNEP Finance Initiative, which just came out in January, testing the application of the EU taxonomy to core banking products, high-level recommendations. And this shows that there are huge gaps between the EU taxonomy and the current practices, and the gaps are really wide in terms of lack of adequate non-financial disclosure by smaller sized companies, and or the gaps are high in multi-sector activities, as this graph tends to represent. Next slide, please. In fact, the small and medium-sized enterprises, not to mention the micro enterprises, and the multi-sector firms are less likely to engage in non-financial reporting, according to any one of the multiple disclosure frameworks that were introduced over the last 25 years, starting from the GRI, the Global Reporting Initiative, and evolving through time. Next slide, please. This figure, together with this figure, is coming from the Directorate General for Financial Stability, Financial Services and Capital Markets Union. It was at the European Commission that commissioned a study on sustainability-related ratings, data, and research, and it was also published in January this year. And here what you see is indeed the significant bias in terms of size. There is a big size-related bias in ESG ratings, in the sense that micro cap with respect to mega cap, you see in the graph above, there is 18, a gap of 18, 64 for a higher rating is good, and mega cap has 64 on average, micro cap has 46 on average, which is a huge difference, more than 1/3 more for the mega cap. And in the lower graph, you can see how the distribution of the ratings quality, the ESG rating quality, ESG rating levels by size of the companies is highly skewed. It is very huge, it's very large, the proportion of the smaller size companies that get disproportionately more representation in terms of the lower ESG ratings. That has to do with probably some also complacency. It might have to do with some complacency bias, but it has to do with also the reality that smaller size companies hardly engage in non-financial reporting. Next slide, please. And to add on that, I also draw this from the same previous publication. We can see that the many rate agencies that issue ESG ratings do not concur much, do not agree much on the ratings level they give. This is a matrix of correlation at the bottom graph. And you see that correlations are very small, in some case, like in the G, which stands for governance rating, you even can find negative correlations across rating agencies, which is kind of really disorienting. And in the top graph, you can see that the correlations are not very high. This to the point that at the MIT Sloan School of Management, there is somebody, Berg, Kohlbell, and Rigobon, who have started a research project which is called Aggregate Confusion, the Divergence of ESG Ratings. So we do have a problem in terms of the availability of ratings for the small size companies and for the multi-product companies. And in addition, the ESG ratings, when they are available, not always they are of good quality. Next slide, please. And this leads me to the final point that I wanted to make, which is that thanks to private and soft information that has been accumulated through repeated interaction and relationship lending, bank, a traditional bank, knows about its borrowers, and it has a unique ability to process that information and use it. So a traditional bank knows more on a borrower than any other external party, even though in the world of big data, we should not underplay the role of these big giants to know a lot more information. But I suppose that highly sensitive information is still asymmetric, and the fact that proprietary private information can be used is going to be very important down the line. So with some training of its staff, a traditional bank can use all of that information to assess whether a borrowing firm is sustainable or not. It would be in the best place to do that. And this provides the ground for sustainability certification, which could be a new trigger for business activities, and it could provide the remedy to the unsatisfactory quality of the ESG ratings and to the need to bring the SMEs into green finance, which is going to be a challenge. So sustainability certification seems to provide a valuable fee income for the banks, also solving the issue of the unfriendly macro environment where traditional banks find themselves with a compressed interest income, net interest income. That's all for the moment. Of course, anything that regards Europe, and my presentation is mostly focused in Europe, is going to be even more important in the Mediterranean and Africa, where the issue of smaller size companies is going to be only magnified. Thank you.
Thank you very much, Giovanni. I think this was very interesting. I have a very quick question on the certification, sustainability certification. So you're saying that the sustainability certification will be done by banks, and they can apply a fee for the companies, but don't you see here an incentive problem? I mean, there is a kind of a conflict of interest where banks, they would probably inflate the sustainability drivers of their own companies, specifically if there is prudential rule within the banking regulation that puts certain risk weights on the ESG factors going forward. So how do you see this?
Well, the issue of ratings inflation has been with us for some time. It was one of the causes of the subprime crisis that we saw 15 years ago. Is there a conflict of interest? Well, there is a reputation mechanism. If you believe that preserving your reputation is valuable, you don't wish to downgrade the value of the ratings you issue. Certainly, this is a kind of change in the mind frame that is required. It's not easy. It will not happen overnight. But at the same time, the banks have to disintermediate themselves because they are too costly. If they do not reduce their assets and liabilities, they are going to be unable to reach the performance that can make them competitive with respect to their competitors, as Barbara was showing us.
Thank you. I just want to go back. You mentioned reputational issues. That's clear. But don't you think reputational issues are much more prevalent for large banks rather than very small banks? Specifically, if we look at the structure of assets of small banks, these are all small companies and so on. So how do you see this? Do you think the reputational issue is as important for large banks than for small and medium-sized banks?
Well, reputational issue is part of, if you wish, reputational capital. so in going ahead, I see that we will regulators will have to rely not only on financial capital, but also on other aspects that will have to be increasingly factored in. So that doesn't clearly the big banks are more exposed to scrutiny by the public opinion, but the small banks do not go exempt from scrutiny from the regulators and supervisors.
Thank you very much, Giovanni. I think this gives a very nice introduction to the next panelist. I would like to welcome Mario Quagliariello. I hope I pronounced well your name. He's a Director of Economic Analysis and Statistics at the European Banking Authority, currently based in Paris. So the department where Mario is heading is in charge of all the analysis of risks and vulnerabilities in the European banking sector, as well as the stress testing function at the European Banking Authority. Mario, the screen is yours.
Thank you. Good afternoon, and Rim, thanks a lot for the invitation. I think I also have a couple of slides, so hopefully they will appear at some point. Okay, thank you. What I would like to do today is to look a bit backward to the European banking sector and see what happened after the great financial crisis. And afterwards, a couple of thoughts on the possible developments because of COVID-19. And if we can move directly to the next slide, please. The idea is to look a bit the key risk indicators for the banks in a more comprehensive way, and link the evolution after the great financial crisis to business model. So if we can move to the next slide, please. I will start with capital, and here I think one key development in terms of business model for the European banks is that compared to the pre-great financial crisis period, banks are operating with more capital and less leverage. Which means, as also Barbara was mentioning in the initial speech, banks entered this crisis with much higher capital levels. The CET1 ratio fully loaded was almost at 15% on average. But more importantly, all the distribution after the great financial crisis moved upward. And there was a sort of catch-up process for the less capitalized banks. Now, still there are some idiosyncratic problems here and there, but overall, the evolution has been positive and steady since the great financial crisis. There was a slight decline of the solvency position of banks in the first quarter of 2020, and this was the result, on the one end, of the high volatility in the markets, which implied an increase in the risk-weighted assets for market risk, and also big use of loan commitments by the non-financial corporations, which again created an inflation of the risk-weighted assets. But then there was a quick recovery of the solvency position of banks, partly because banks moved to public guarantee. So some of the loans were guaranteed by the government, and also because the Commission approved the CRR quick fix, which, among other things, for instance, included some measures reducing the risk-weighted assets. One example is the SME supporting factor, which became let's say a bit more generous and also expanded the definition of SMEs, so the scope was wider. I think what is also interesting is that this improvement in the capital position is not only was not only driven by a risk-weighted assets aspect, but also if you look at the non-risk-based metrics like the leverage ratio, the improvement since 2014 is clear. And before the start of COVID crisis, the leverage ratio was well above 5%. And you know that once the leverage ratio will be a binding requirement, that will be 3% threshold. And also in this case, there was some of the support measures during COVID was the possibility for central banks and for the supervisor to exclude the central banks exposures, which was done, for instance, by the SSM. So this again was a boost to the leverage ratio, which basically means more headroom for banks to provide lending to the economy. Moving to the next slide, the other big change in terms of banks' business model was on the funding side. There is now much higher share of stable funding, long-term funding, especially customer deposits, and the banks entered the COVID crisis with very high liquidity buffers. The liquidity coverage ratio was at around 150%, and as you know, the requirement is 100%. And actually, the liquidity coverage ratio increased after the start of the crisis because of the central bank's interventions. So it's, let's say, plenty of liquidity. At the end, I will also perhaps comment on the fact that not all this liquidity has a, let's say, good profitability. So there is also a trade-off between hoarding liquidity and recovery in terms of profitability. There was also a big increase, a structural increase in customer deposits, which is also reflected in the gradual improvement of the loan-to-deposit ratio. And this was also confirmed at the start of this crisis, which again goes in the direction that previous speakers were mentioning, that this crisis was not determined by the banks. Actually, the banks could be part of the solution. And I think this was perceived by market participants and also depositors, because there was initially an outflow from money market funds, and some of this liquidity went to the banks deposits, which I think is a signal of the trust in banks during at least the first stage of this crisis. And then, of course, deposit was very easily available thanks to the monetary policy after the start of the crisis, which means that banks focused the funding especially on getting enough MREL eligible instruments and other eligible instruments for regulatory capital. Moving to the next slide, let's say the third element post-great financial crisis in terms of business model is the gradual improvement of asset quality, which of course was one of the big driver of the previous crisis and one of the big consequences of the previous crisis. And if you look at this chart, which is showing the evolution of NPL ratio since 2014, when we introduced the common definitions in Europe, you can clearly see this positive trend, which again has been consistent, has been robust, has been involving basically all banks, all countries, and all economic sectors. Which means that once again, banks entered this crisis with a better position if you look at asset quality. But as was mentioned by Barbara at the beginning, still with some countries and some banks with relatively high NPL levels, still higher than before the great financial crisis. And of course, this legacy probably would have been addressed without COVID crisis, but now we expect a new increase of the NPL on the NPL ratio. I mean, I would say probably with a couple of years more before the next crisis, the behavior of banks in terms of NPLs would have been a success story, because as you can see, the trend is very positive. Of course, given the fact that COVID erupted in 2020, what we can say, also looking at the dynamics of the NPLs, is that the adjustment was good, but probably started too late. And this is one of the big differences between Europe and the US, where the repair after the great financial crisis started much earlier. So we could be in a better position now, but once again, I think this chart is also showing the efforts of the banking sector in fixing this. Moving to the next slide, this is instead what we expect to happen because of COVID. Now, first, I think what is interesting in this crisis is that there are two elements which make the crisis very different from the previous one. First, there was an increase in lending in the first quarter after the eruption of COVID. And this, as I mentioned, was mostly driven by the need for non-financial corporations to get enough liquidity to absorb the lockdowns in different jurisdictions. And also, so far, there is basically very little sign of an increase in non-performing loans. Now, on the one hand, this is not different from previous crises, because normally we know that there is a lag between the deterioration of the economy and the impact on asset quality. And in addition, for this crisis, we can expect a longer lag since several support measures were introduced, and it is likely that the increase in NPLs will start once the measures are lifted. And still, notwithstanding the fact that the NPLs are stable, actually slightly decline in the first quarters after the start of the crisis, we do see some early signals of deterioration of asset quality. First, stage 2 assets increased. And of course, this is a first signal that there is a material increase in credit risk. And also there is an increase in the share of forborne loans. So there are some early indicators of a deterioration of asset quality. And of course, the final impact of the crisis will depend very much on how quickly the recovery is going to be. Now, there were, I would say, early this year, some optimism on the vaccination process. Now, this is a bit less clear, less certain. So we don't know yet how conservative we have been in the past in estimating the possible increase in NPLs. You may recall that one analysis that we ran and published in April last year was estimating a level of NPLs comparable to the post-Great Financial Crisis, so around, let's say, 1.5 trillion. Now, again, this could be a pessimistic view depending on the speed of the recovery, but is important that banks are prepared to deal with this increase. Moving to the next slide, I think this is interesting because it shows, on the one hand, the use by banks of the different support measures, especially moratoria and public guarantees, but also the quality underlying the loans under moratoria. And here, as you can see, in September 2020, there were slightly less than 600 billion of loans under moratoria. And the percentage of total loans depends very much on the country. But I would say, if you look at the different European countries, you see that there was a wider use of moratoria, especially in these countries more affected by the crisis. And the main recipients have been small and medium enterprises and those economic sectors more affected by the lockdown and the other distancing measures. I think it's also interesting because we start getting some information on asset quality of the loans which exit the moratorium because the moratorium expired. And here you can see that there is a slight difference between loans still under moratoria and loans for which the moratoria expired. And the asset quality of the loans still under moratoria is a bit lower. Now, this can suggest, even though it's a matter of interpretation, that banks prefer to keep under moratoria those customers which are riskier or are struggling more because of the crisis. Moving to the next slide, this is the after, let's say, capital, funding, and asset quality. The last important element of banks' business model is profitability and operational resilience. And I think here was already the weakest link for banks ahead of the start of COVID-19. Basically, profitability never really recovered since the Great Financial Crisis. There was a partial recovery for some banks, but overall, the sector remained overbanked, high cost-to-income ratio, as also Barbara mentioned, relatively low margins and low net interest income because of the low interest rates environment and the competition of other players. I think on the positive side, there is some sign that the operating expenses are declining. This was very evident in the first 2 quarters after the start of the COVID crisis. But to be honest, it's too early to say whether this is a structural improvement or is just a conjunctural improvement, also linked to the fact that banks moved so quickly to, let's say, teleworking and digital banking. Also, if you look at the positive developments triggered by the crisis, that banks were able, to some extent, surprisingly, given how fast the move was, they were able to move to digital banking, to teleworking, almost without any interruption of the key services and critical functions. And of course, there is a much more reliance than just 1 year ago on digital platforms outsourcing to IT players, which of course I think is positive because again, banks were able to be the transmission channel of some of the government support measures, but on the other hand, this also increased the possible risk coming from IT, cyber attacks, and so on. So I think this is another area on which banks need to be careful. And the other aspect, of course, is all the customer, all the conduct risk, which is perhaps becoming more relevant since banks are now operating in a digital environment. So the reputational cost of some misconduct can be even more relevant now. And moving to the next slide, which is also my last one. Here, I think there are just some thoughts on what can happen and what should not happen because of COVID. The first one is, I think we really want to avoid the repetition of what happened after the Great Financial Crisis. I mean, if you recall, there was a stage in which banks were considered as not enough capitalized. Then there was the recapitalization of the banks, and there were still there was still mistrust on the banking sector in terms of the credibility of the risk-weighted assets and the asset quality. So here is important. This time, we mentioned many times, this time is different. Banks should have timely, conservative, and transparent recognition of credit risk, and they should provision accordingly. They should prepare for the worst. Perhaps our estimates are too negative. They will recover this, but it's better to be prepared, because what we don't want to do is, let's say, in 1 year time, massive asset quality review for all the European banks. The second element is what I was mentioning on banks having large liquidity buffers. We did say, as we did say for capital, that the buffers are there to be used during a crisis. And for liquidity, I think the key element is that a large part of these buffers are offering very low, in some cases, negative returns. So there is an issue of profitability. And while the low for long interest rates are very positive and potentially they will help banks in dealing with the deterioration of asset quality, they could create an incentive to leave in the market zombie firms, or to leave in the bank or in the market some banks with not sustainable business models. So I think in this case we should be selective and allow this crisis to be a trigger for the restructuring of the corporate sector and of the banking sector. Especially because, as I said, the cost-to-income ratio is very high for many banks and in several jurisdictions. Digitalization is probably the way to go, having in mind, let's say, two main risks. One is, as I said, ICT risk, and the second one is the risk to leave behind some weaker customers. So I think here is important to keep in mind financial inclusion, because moving to digital banking so suddenly can be problematic for some of the weaker customers of the banks. The restructuring of the sector is long overdue. So I think this should be a good opportunity for reduce the number of banks and allowing the orderly exit of those banks with not sustainable business models. And I think what is key is to also be sure that during this crisis there is no, again, loss of trust in the banking sector, which also means that aspects like operational risk, conduct risk, following AML rules is key for the banks, not only for the possible losses that they can generate, but also for the overall trust in the banking sector. And this has been, I think, explained very well by Giovanni before me. Clearly, banks also have a big role to play in helping the transition to a greener economy, and I think this cannot be excluded from the rethinking of banks' business models. By the way, we are planning to publish, hopefully in a couple of months, a first report on the let's say climate change risk, and the first effort we made was just helping banks and in mapping the exposures for understanding better how much of their exposures are, let's say, more or less climate friendly. This is just a start of a, let's say, wider project, but would be a good starting point for having good understanding of the challenges banks are dealing with in the classification of the assets between, let's say, green, brown, and whatever is in the middle. I think I will stop here, and thanks a lot.
Thank you, Mario, for this very comprehensive introduction. I have one question based on your experience and also the research you're doing on banks and all the vulnerabilities of the banking sector in Europe. How do you qualify a non-sustainable business model in banking?
Well, this is a great question. I'm not sure I have a good answer, but I would say every time we discuss with the banks and also with other authorities on business models, we always have, let's say, the easy point, which is not for the supervisors or for the regulators to tell which kind of business models banks should adopt. But I think there is one point which is a bit more objective. So definitely the attention on the cost side is has a big impact on banks' profitability. Now, to be realistic, it's very unlikely in the medium term for banks to recover much in terms of interest income, partly because of the low interest rate environment, but partly because it's a more structural development. And if you look at the banks in most jurisdictions, again, cost efficiency is low. In some cases, the cost to income ratios are very high. So the costs are absorbing large part of the income. So I think this is really the area on which banks should be working. More focus on the digitalization is definitely the way to go. Then, of course, there are many elements which are more idiosyncratic, so it is for each bank to decide which is the right business model. But what we see is that for now, many years, the return on equity was not enough for covering the cost of equity for many banks, and clearly this is, I think, a good proxy of a not sustainable business model.
Thank you. That was very clear. I think what is important is that profitability and cost efficiency should be the pillars for sustainability, at least one of the pillars of sustainability so far. Thank you. I would like to move on to the next panelist. Let me welcome Jorge Sicilia. He is the chief economist of the BBVA group and the director of the group research based in Spain. Jorge leads the global team of economists all over the world, in Europe, US, Turkey, Mexico, South America. So it's a global bank. In our classification of business models, I think BBVA is a diversified group, but later on Doriana can confirm it. So I would like to give you the screen. Please, Jorge, you can start.
So thank you very much for the invitation to be here with you. Thank you to the Euro-Mediterranean Economist Association. I am going to benefit from what my fellow panelists have been discussing. I only brought kind of 6 slides, and I want to touch upon the 2 issues that have been discussed here. The first one is on bank sustainability and how to make sure that banks are able to adapt to an environment in which they need to change the way they operate in order to make sure they are sustainable. And that incorporates not only doing things to adapt to the interest rate cost environment, but also to the trends that are going to materialize, especially after the COVID crisis. And also I will dedicate a few slides to discuss about the greening and the greening of the economy, the challenges for bank, but also the issue of social awareness. So let's go to the next slide, please. And you're right, in a sense, we are a diversified bank. We are very much present in Europe, in the US, in Latin America, and in Turkey. Now, this gives us an overview and a resilience in terms of diversifying not only our sources of revenue, but also the hiccups that different markets have at different points in time. So don't get me wrong, diversification is a great thing and has played greatly to the benefit of the bank. But I want to bring to your attention here with this slide the fact that this time around, although it's not going to be different, some of those benefits are going to be a little bit less pronounced than in previous crises. Here, for two reasons. One is related to interest rates, and I think that this crisis has brought two countries which used to have high interest rates to a position where they can keep, or they are willing to keep, low interest rates for longer. So not at the extremely depressed levels of developed economies, but certainly closer to what was the case in previous crises. So in a sense, this is going to be a global phenomenon, as should be, given that this is a macroeconomic problem that stems from an excess savings. But also this time around, we do have forecasts that point to the fact that in emerging economies, although credit is going to grow significantly more than in developed economies, is not going to be as much as before. So here on this chart, what you see is the kind of the forecast that we have for a subset of developed economies and a subset of emerging economies in which we are present. And what you see there is that credit growth is going to suffer also in emerging economies. So the combination of lower credit and low interest rates is going to be something that is going to affect significantly the profitability of banks. Next. Now, this doesn't mean that there is nothing that banks can do. I mean, quite the contrary. I think I can spend very little time here, considering that some issues have been already raised. First, there has been a huge effort in terms of cost cutting that has accelerated in 2020, and there is still room to go. There is significant heterogeneity in the data that you can find for different banks, but overall the picture emerges that European banks can do more if you consider that the US might be a benchmark with which you can compare yourself. It's not exactly like that, but for sure the efforts on cost cutting is something that European banks have to do, but it's also an issue that is going to be relevant in emerging market banks. They have probably not needed to focus so much on this, given that profits were high, but as I discussed before, this is likely to be less of a benefit in the future. The second issue is that this is going to be needed, especially in the short term, especially in the post-COVID world, because it is likely that the cost of risk is going to be high. Probably not as high in 2021 or 2022 as it was in 2020, but in any case, this is going to be something that banks are going to need to digest in terms of the scarring and the aftermath of the crisis in the coming years. And this probably means that in the near term, and near term I mean 2 or 3 years, what we're going to have is a world in which profitability will remain a big issue, and that the key for success is going to be the need for put much more effort on bringing cost efficiency under control in order to make sure that the return on equity, return on assets, on tangible assets, whatever measure you want to use, increase in European banks. And this is an absolute must, because you have to, of course you know, but you have to keep in mind that this is basically the ability to generate profits in a bank. Means that endogenously a bank can generate sufficient capital to sustain their operations. So if we go to the next slide, I highlighted there a few issues that I think are relevant. So to understand how we need to adapt to this profitability and cost-cutting issues at a time where there are some trends. Many of them were already important before the COVID, but certainly the COVID is going to accelerate those trends. So first, we're dealing with a shift in preference, in a sense that digital solutions for customers are being demanded by customers, are being also in the interest of banks, not only in the effort of reducing costs, but more importantly, in the need to provide a value added for customers that are demanding it. So this is a trend to which all banks are going to need to adapt very quickly and across the board. And certainly the COVID is going to accelerate this trend. Now, this cost reduction needs, at some point in time, what we need to make sure is that they remain at bay when we increase activities. So in a sense that we manage to have a sufficient customer base with a cost structure that allows that the increase in customers does not necessarily entail a need to increase costs, the marginal cost at the same pace. And this is going to require, not only cost cutting, but also improving the ability to gaining new customers with the same digital infrastructure and payment infrastructure that we have. The third one is the shift in teleworking. I'm not going to get into this, but this has been a major determinant of how the labor market has performed. The ones that in businesses that have been able to telework have done much better than the ones that have not. So in terms of resilience, teleworking is something that is here to stay. And this can be used also to think in terms of increasing productivity and increasing efficiency. Of course, you need to train people to telework, but this is something that is going to be here to stay, and it's a trend that we can rely on to also change the business model. And then there is this issue of the big tech and fig tech, the digital platforms. Here, the big question is not only how we compete, but also how we deal structurally with the risk, which is not an easy task. We can get into this later on. Some other colleagues in the panel have made some relevant remarks. But the issue here is who is going to have access to the client, right? And whether that client is going to perceive the service being better provided by one or other entity, be it a bank or a platform or a big tech. So even though there is a big regulatory issue at play, and this is something that, as I said, we can talk later, eventually it boils down to providing a safe environment and a good service to our customers. So if we go to the next slide, these are the kind of 4 areas where I think banks really need to think very carefully in terms of what needs to be done. First of all, embracing digitalization, and they need to transform their business channels they need to help employees, and they need to face the new players in a playing field that is changing, and it will continue changing very, very quickly. To do that, they need to adapt to clients' needs, and that means helping them in many areas in which banks can and others can provide that service, and eventually it will be up to the clients to decide how to be served by banks. And if banks are not up to the task of adapting to what clients need, that is a business model that will not succeed. At the same time that banks do that, efficiency needs to be enhanced. And here, although until now I have only talked about cost control, I mean, this has a long way to go, but there is a limit. And really, at some point in time, revenue need to kick in a way that makes that this business is profitable. In the short term, of course, M&A can play a role, but eventually, again, we will need to think about what is the core business of the banks and how to serve clients in an adequate way. And in this regard, it's going to be key to diversify revenue, and there are many ways in which this can be done. I'm not going to get into that. So next. So my in a sense, my last slide, because there's another one, but it's relatively easy to go through that. And I want to turn into sustainable banking. And here I want to broaden a little bit the discussion of what some of you might have in terms of understanding what sustainable is. I mean, for us in our bank, this has both an environmental and social dimension. And the targets are clear. The target is something that the society itself decides eventually, both on the environmental and the social. And within those preferences of society, and those preferences transform into both demand from clients, demand from stakeholders, and demand from regulators. Within this constraints and preferences is where banks need to find their role. And I think that in terms of environmental, it's very clear that we can support the climate transition of businesses. I mean, you have to understand that banks really are almost net zero by themselves, almost, or they can become net zero very quickly, but they do have customers that are not necessarily net zero. So I don't really think that it's a role for the bank in isolation to, by regulation of the banks, change the attitudes of clients in different businesses. There's going to be a need to regulate those businesses or to introduce incentives in terms of increasing the carbon cost. But of course, there is a measure in terms of how environmental friendly the client of a specific bank is. And in this regard, I think banks can play a significant role, being able to shore up their assessment capability and driving financial products in order to help our clients to transition to this new environment. You have to remember that clients, a bank basically hold assets, and we have a huge potential risk here if preferences change dramatically, or if regulation changes dramatically, and the clients that we have eventually become, to some extent, stranded assets. So this is something that is key for banks to understand and to follow very, very carefully. But also social. And I think that an issue that is very relevant for banks is to support households' financial health. So this goes beyond financial inclusion, I think, but is in a sense related in order to help our clients to become safer in their financial decisions that they make. And those are related to households and also to firms. And finally, next, my last slide. It is true that banks have played a role in moratoriums, as it was being discussed before by Mario. I mean, it's clear that we're simply transmitting policies and guarantees that are generated by the governments in different countries. But this has proven, not only in developed economies, but in emerging economies, that having a banking business that is ingrained in society certainly improves the ability of policymakers to direct those aids quickly into people that need them. And for that to become much more efficient, it's clear that, going back to this financial inclusion issue that we discussed before, the more people are banked, the easier it will be to conduct these policies in the future. I will leave it there. Thanks so much.
Thank you, Jorge. This was very good introduction. I have one question which comes from the presentation of Giovanni. I would like to have your view about the sustainability certification as a bank, and also very much involved in SMEs portfolio and so on. Do you see yourself, for example, providing such certification of sustainability for small and medium-sized enterprises based on the data that you have on your SME portfolios?
Well, there are a couple of issues there. I mean, one is the one that you raised in your question, and that is related to the fact that you cannot be an interested party. But second is the fact that I mean, a bank is an intermediary in a sense. So I'm not trying to preempt any other answer, because there are many potential different business models that you can build here. But I see here that the role of the bank is more intermediating between firms that are specialized and can provide that service or that rating and our clients, more than the bank doing it itself.
Thank you. Now I would like to move to the Q&A. I have prepared a few questions to you, if we can put everybody on screen. So my first question is about, you all mentioned about all the mitigation measures that have been provided to the banking sector to dive into the global COVID-19 pandemic. So how do you see the timetable and also the consequences or potential consequences of the lifting of this relaxed, in a way, regulatory measures to mitigate the COVID-19 pandemic on the bank business model? So how do you see this? I would like to start with Jorge.
Sure. Thanks for the question. So actually, what I mean, first things first. I mean, these are policies that needed to be implemented, and it was a part of broader policies. This was fiscal policy coming to the rescue, monetary policy doing it, and regulatory policy, in a sense, accompanying this effort to make sure that the damage to the economy was as low as possible, expecting that this shock was going to be transitory. Now, for all those policies, actually, so what I'm going to say, I think it applies to all the policies that have been implementing. What we need is a clear timetable of how this is going to be phased out. And there is both a danger of coming out too soon or too early in all these policies, monetary, fiscal, and supervisory. And also, there is a danger in coming too late. And this probably means that what I think it would help best those policies is to make sure that there is a long-term plan and a timetable to get out, even though that plan might be conditional on what is the state of the economy, but eventually everything needs to go back to normal. Now, in terms going into a little bit more a differentiation in the three policies. I mean, for fiscal policy and monetary policy, I think there is room to continue implementing measures up to the point that we are absolutely sure that we're out of the woods and that the scarring is not permanent. But I also think that part of the impact on the banking sector is dependent on these two policies focusing on something that is now key and that will affect the banking sector in the future, and is to make sure that there is some type of incentives to an increase in the equity of firms. So there has been probably too much effort on debt and perhaps a little bit less effort on building equity. And there are many things in which this can be done. And this certainly would increase the health of the economy at large and of the firms. And eventually it will have an impact on the banking sector. And at the same time, we should use this time also to make sure that we shore up all the insolvency framework in which we need to make sure as societies that insolvent firms they are resolved quickly to make sure that the value of the assets can be recovered and put into play. So the fact that I think that more time is needed doesn't mean that I think that the current policies need to stay the same. I think they need to be geared towards these issues in the margin.
Now, Mario.
Thank you, Rima. To be honest, I'm happy to get the floor after a bank, because I think I honestly agree on many points. I have just a couple of additional comments on others. One is, I mean, on the let's say a phase out of the measures. I think there is an interesting question, especially for the measures, let's say a bit more under the EBA remit, on whether all the measures remain effective over time. And what I have in mind, because it's probably one of those which is more sensitive or debated, is the moratoria. First, I think I need to clarify that clearly the EBA measure is not the moratoria itself, which is coming either from some legal initiative or banking sector-wide initiative, but these the guidelines on the prudential treatment of moratoria. And here, a question which I have is, let's say, for how long having a specific prudential treatment is actually effective? Because the longer the moratoria is, the more likely is for the customers to be unlikely to pay. So eventually, the real benefit of a different prudential treatment is lost. So I think on this, we shouldn't overestimate the benefit of keeping too long some measures, which, by the way, doesn't mean that banks should not grant moratoria or payment holidays if needed, or let's say normal forbearance, if this is potentially helpful for the customers. Otherwise, let's say we go back to the discussion we were having on zombie firms after the great financial crisis. The second point on which I agree with Jorge is the fact that there should be clarity on the phase out of the measures. Now, I would say, of course, we can always improve on the capital relief measures. I think there was some communication on when, for instance, P2G is expected to be met again. And also this is conditional to the overall situation improving. So I think banks have been given some clarity, at least for some of the measures. Of course, it is also true that there is a lot of uncertainty on the future evolution of the pandemic, which makes being sometimes too clear or prescriptive or committing is a bit more difficult. So this is the other point, and this is also one of the reasons why we consider the stress test we are currently running as very important, because hopefully we'll give a bit more clarity on the forward-looking perspectives of the banking sector, and at that point we should have more clarity and should be able to give more guidance to the banks. And I think I will stop here. Thank you.
Thank you, Mario. I would like to give the floor now to Giovanni for the same question.
Thank you, Rim. About the effectiveness of the moratoria and how long it should be carried forward. My sense is that over time, as it was already mentioned, certainly by Mario and perhaps also by Jorge, these measures tend to become ineffective, and we should not expect too much. At the same time, what was the original motivation for the moratorium? It was that there was a sudden drop in demand for businesses, and or a sudden drop in income for households, and so since that shock was totally unexpected, you needed to give them some time to readjust, and hopefully the demand for the firm's output and the income in the households would be returning. However, that is possible, and certainly we know that after the success, which is coming, hopefully, of the vaccination campaigns, we will be resuming something which is normal, but it will be a new normal, and therefore there will be differences across sectors. Think of how much mobility will be in the new normal with respect to what we had in the past before the COVID-19. I mean, these very facts that it has become natural to have online interactions will probably diminish on a permanent basis the demand for mobility linked to businesses. But at the same time, we also know that it is very unlikely that we will return to the massive tourism flows that we had seen in the past with low-cost carriers on the skies of Europe and the rest of the world. So a granular approach will have to be needed, because if you can still assume that demand will be returning under the new normal, the moratorium is still justified, because firms in general in those sectors might have a chance to survive. And then, of course, everything has to be judged on an individual basis. But regarding the sectors that will not have a return of demand in the future, under the new normal, it is better to close those businesses, the sooner the better, and to accompany the unemployed through training programs in order to make them employable again.
Yeah, that's very clear. And this is why assessing the quality of companies by banks, it's very important also to segregate the ones that are still viable from those that are not viable. This is extremely important exercise to be made also that could help this exercise. Barbara?
I have very few things to add here. Most of the good points have already been made. I just want to add a couple of things. In the UK, we have been in lockdown since just before Christmas, at least in London. And new data that has been recently released shows that the economic impact of the second lockdown has been a lot smaller than the first lockdown. This is for two reasons. The fact is that people have got used to working from home, and a lot of businesses have managed during the last almost 12 months manage to change the way they do business. So there has been already a very fast evolution, and the loss of profit in a lot of sectors has not been quite as severe during the second lockdown. The other point that has been touched upon by Giovanni is that this crisis has not touched all sectors in the same way. Some sectors have been actually almost untouched. So apart, for example, from a real panic around March last year, universities have been working as usual, probably working even more than before. Similar, all the tech companies, all the online retailers. So there are a lot of sectors that have not seen a drop in profitability, whereas some sectors like tourism and hospitality and other sectors have been really severely impacted. So when we talk about stopping all this aid, the decision should be made sector by sector, and importantly, we should ask questions as to whether we really want to prop up sectors that might have been destined to be phased out as societies and economies evolve and clients, people, customers' taste change, and there is this new drive towards a green economy. So maybe, as Giovanni said, we should really think about creating something new, and this is something that I have seen. The other thing that I want to add, and is a very quick point, is that they seem to have shown that there is a lot of pent-up demand, and the expectations, for example, from the Bank of England, is that the economy might bounce back a lot faster than a lot of people feared. So there is also some optimism as to how fast we can go.
Thank you, Barbara, for this. Thank you all for responding to this first question. Now, before going to my second question, also I see one question from the audience. I'd like to hand over to my colleague Doriana Cucinelli. She's a researcher at the University delle Studie di Parma and research fellow at the Euro-Mediterranean Economists Association, to share with you some of our latest work and the research that we are currently undertaking to shed some light on these aspects of sustainability in bank business models. Doriana?
Yes. Okay, can you share the presentation? Okay, thank you. Next, please. In this short presentation, I want only show you, next slide, please, show you some results of our business model monitors, and also some next steps. So what are we doing in this period on the bank business model monitor? Next slide, please. Next. And with this presentation, I want to try to give a very short answer to this question: when is bank business model sustainable? The Global Alliance for Banking and Values formulates a sustainable banks as providing services and products that satisfy the needs of the economy and people. But when we talk about the bank sustainability, we need to consider both the bank's profitability, its resilience, and also its stability. As said several times by the panelists who preceded me, in the last decades, banks improved their asset quality, but also their bank capital and the risk management. Although this, the bank profitability remain low, and the ECB has highlighted that the low bank profitability is a key risk to the euro area financial stability. Therefore, to achieve a sustainable business model, banks should act on three main dimensions. These dimensions are capital, revenues, and also the cost management, that in this period with the low interest rate and the low profitability to an efficient cost management became crucial for the sustainability of the bank business model. Next. So, with regard to the bank business model monitor, what we done in the past, we have identified the bank business models for a sample of European banks, and to define this business model, we use a cluster analysis on a sample of more than 3,000 European banks that we observed since 2005. We obtain 5 different business models. One focus retail, that is the business model more retail oriented. The wholesale business model that refer to the business model to the banks that operate more in the interbank market and investment. We have also 2 different diversified retail business models, the type 1 and type 2. What is the difference between the type 1 and type 2? Both these diversified business models are retail-oriented business model, but the difference is on the composition of the asset and liability side. In particular, the type 1 show a higher diversification on the asset side with not only customer loans but also trading assets, while the type 2 show a higher diversification on the liability side. Next, please. We run the cluster analysis each year, and these allow us to observe also the changes in the bank business model. This means that the concept of business model is not a static business model, but banks change their business model along the period that we observe. In particular, we observe a very high persistence, but about the 10% of the banks of our samples change at least 1 time the business model during the period that we observe. Next. Now, with regard to the performance, in these charts you can observe the evolution of the return on asset and of the return on equity of the different business models. And what emerged is that, in particular, during the financial crisis of 2008 and 2011 to 2012, there are some business models that show negative performance. In particular, these business models are the investment banks and also focus retail. While the diversified banks that adopt diversified business model show, although they show a decrease in performance, they remain with positive performance during this period, and after the crisis, all the business model increase their performance, although the level of performance remain lower than those that we observe before the crisis. Next, please. It is important to observe the composition of profitability. In fact, when we go deeper in the composition of income, we can distinguish between interest income ratio and the no-interest income ratio, and we can obviously observe how the focus retail depend more on the interest income ratio, while the investment depend more on the no-interest income. But what is important is that the diversified banks and in particular the diversified retail type 1 show a more diversified income, and this is one of the reasons that for which this business model perform better also during the financial crisis. Next, please. To improve the bank profitability, banks can follow 2 different ways. They can try to increase their income, but in this period with very low interest rate and with these macro conditions, it could be difficult to increase income, but they can also try to reduce their cost. Therefore, the management of cost became really important and crucial for the sustainability of the bank business model. Next, please. Finally, with regard to the capital, in this slide, we can observe how the Tier 1 capital ratio, the evolution of Tier 1 capital ratio during the last 10 years, more than 10 years. And we observe how, thanks also to the regulation, banks increase a lot their capital requirements, and in particular we observe a greater increase in the wholesale and investment bank. However, all business models show very high level of Tier 1 capital ratio. This depends on both the increase in capital, but also obviously in the decrease of the risk appetite of banks, as we can observe in the second chart. Next, please. Finally, in terms of bank stability, we analyze also the contribution to the systemic risk that is proxied with the S risk, and the distance to default proxied by the zeta score. We can observe that also in this case, the different business models perform differently. In particular, with regard to the S risk, as we can expect, investment banks and also the diversified retail type 2 show a higher contribution to the systemic risk, while in terms of distance to default, focused retail and diversified retail type 1 banks are furthest from default, while investment banks are the closest to default during the financial crisis. Next, please. Also, the bank conduct is an aspect, a really important aspect. In particular, banks conduct cost in the post-crisis, area continue to be a matter for concern, and they remain even more relevant in the current COVID-19 crisis. The Center of Banking Research of Casu Business School, together with the EMEA Association, work on the Conduct Cost Project. This project aims to foster transparency in financial activity and to deliver a category of benchmarking which comprises the level of conduct risk of the banks. Next, please. In these two charts, we can observe both the occurrences that give rise to a conduct cost, but also the consequences of misconduct. What is important is to understand, to remember that the consequences of misconduct are not only fines and penalties, but these costs can arise also from a regulatory directed redress or out of all other consequences of misconduct. Moreover, with regard to the ESG criteria, from a conduct cost project perspective, a number of the ESG risks overlap with the scope of the conduct cost and might improve the general awareness of the decision-making landscape of the financial institution. From today, the website of the CBR Conduct Cost Project is online, and you can find more details on this project. Next, please. Now, some information about our next steps. Next. With regard to the bank business models in Europe, so on the bank business model monitor that refer to the European countries, we are collecting data on the ESG scores from the Thomson Reuters Econ database, and the data are available only for a subsample of European listed banks. We collect the data on the ESG scores and its components, but also on the controversies score. What are the first impression? We can observe some differences across the different business models. In particular, it seems that wholesale and investment banks show better E-score and G-scores, and therefore also ESG scores. But in terms of controversies score, these two business models show the lowest score, and therefore also the lowest combined score. Next, please. And with regard another business model monitor, in this period we are collecting data we are collecting data from SNL Unlimited database for also MENA and Africa countries. In particular, we collect data from 30 countries for a total of 585 banks, and we observe the period from 2010 to 2019. We use the same cluster analysis that we use for the European countries, but in this case, the difference is that the cluster analysis is run on each country and not on the total sample. This because the regulation in MENA and Africa countries differ across countries. What we obtain? We identify different business model. We identify the 5 business model that we observe also in Europe. Therefore, we have also in this case focus retail, wholesale, investment, and the 2 diversified retail business model. But in these countries, we find also other diversified business model. In particular, we find other 4 diversified business model. In reality, these other diversified business models are similar to the type 1 and type 2, but differ on the composition of the asset and liability sides. It is important to know that these business models are not present in all countries. There are some countries that show only 2 business models, other 3, other 4, up to a maximum of 5 business models. Next, please. This is my last slide before the conclusion. Although we find in the MENA and Africa countries 9 different business models, it is important to know that most banks, about the 82% of observation, are identified as focus retail, diversified type 1, and investment bank. Therefore, the other business model represent only a little share of the total observation. In conclusion, next slide, please, what we can say about the sustainable of the business model. Next slide. Sorry, here we have, yes, there is a slide on the return on equity and return on assets, but there is a little, next please. There is a little problem with the second chart, but what we can say here, we can say that also in this case, we observe very different business profitability when we look at the different business model. In particular, with regard to some business model, we observe also negative performance during and also after the Arab Springs. In particular, these business model are the diversified retail type 5 and the diversified retail type 6. The type 5 is a little bit strange business model because in this business model we find a diversification on the liability side, but on the asset side, the main component of the total asset is represented by cash. With regard to the diversified retail type 6, is similar to the focus retail business model, but in this case, the asset side, the main component of the asset side is represented by the customer loans, but the funding derive mainly from debt liabilities. Next slide, please. In conclusion, what is important for diversification, for the sustainability of bank business model? The diversity of business models in European banking, but also in MENA and Africa countries, matters in terms of financial performance and also in terms of contribution to the systemic risk and the impact on financial stability. Different business models may have different degrees of resilience to the new macro-financial environment. But although some business models perform better than others, it is important to remember that diversity is important to have a stable financial system, and therefore a more heterogeneous banking system is more able to mitigate the systemic risk. To be sustainable also after the COVID-19 crisis, banks may improve their profitability, and to do this, they should try to have a strategy that consider not only the income, but also the cost management and the quality of capital. Thank you.
Thank you very much, Doriana. So this really gives you an idea where we are in our research. Of course, I must say that we have challenges to collect appropriate data for the Middle East and Africa. So we had some challenges. But then what is interesting here is to apply the same methodology, which is a quantitative methodology based on asset and liability, to understand exactly what those banks are and how they really channel their activities to the economy. So it is very important that this information is also, as I mentioned, publicly accessible, to allow also the public to see which are the business models that function better than others and so on. But this is one thing that we are working on, and it's work in progress. So we are almost at the end of our webinars. I would like to thank you all, but before I close, I would like to ask each one of you, and starting with Barbara this time, to say a final word about sustainability in bank business models, and how do you see, the way forward?
Thank you, Rim. I'd like to use my 1 minute to actually pick up on some of the questions in the chat. And one of the questions is from one of our colleagues on the Conduct Cost project, and he's asking, how can the public assess a bank's success in attaining sustainability goal? That is an interesting question, because we've been looking at it from various perspectives, and it would be really interesting to hear very brief comments on that. There are a few institutions that are producing ESG scores, but we have heard during Giovanni's presentation that there is the issue of conflict of interest and potential rate inflation. And what we are trying to understand is, what are banks really actually doing to avoid, if you want, we've been talking about greenwashing or just investing in particular products to have a certification or a check. So this issue of sustainability of business models and ESG and the meeting of ESG criteria is definitely very important for sustainable bank business models. But how to quantify this as an academic to try and measure it is still very, very difficult.
Thank you, Barbara. Giovanni?
Thank you, Rim. First of all, congratulations on the very important work that was done enlarging the bank business model monitor to these countries, on which data is not easy to collect. My suggestion would be to further clarify maybe some of these countries. You can also find Islamic banking, and it would be interesting to see what can be said. There is a literature on that, and I'm sure you will do further analysis. I don't know. I don't have a view, but they seem to be different in general with respect to ordinary commercial banks. Second point is that it is, given the depth of the crisis we are in, how unexpected this pandemic shock was, we are in a difficult position to forecast which will be the way out. Certainly, banks will need to be really flexible in terms of finding new ways to find businesses, to cut costs, to restructure production and products. And I suspect on the longer time perspective, we need to consider that it is there is something which is not sustainable for banking, which is to be the most regulated sector and the most burdened sector by regulation with respect to the other competitors. So either the non-banks are brought under some regulatory stringency, which makes a level playing field for the banks, or the banks are freed from some of the burden. It is not possible to see otherwise that our societies will obtain economic efficiency by having a really asymmetric treatment across the board. Thank you.
Thank you, Giovanni. Mario?
Thank you. I will also perhaps follow the previous speakers. So one, as Barbara did, I will also mention probably it's not a measure of success of how banks are behaving, but clearly Pillar 3 is very important. We just released the consultation paper on Pillar 3 disclosure for ESG factors. And there we are suggesting a green asset ratio, which could be, let's say, a first synthetic indicator of banks' exposures towards more sustainable assets. Now, this is, of course, just a starting point, is a consultation paper, but I think this is part of the possible solution for making more transparent what banks are doing. Second aspect I would mention is in terms of, let's say, final message, perhaps is not what you expect from a prudential regulator, but I think the attention on the customers is very important. This has been mentioned many times today. And this involves all the areas of banks' operations. This is something to keep in mind in managing asset quality, in deploying moratoria or forbearance measures. It's also important in terms of moving to the digital channels, and also in more generally, banks are there for offering advice and being transparent with the customers. And I think this is the way for recovering also trust and long-term profitability. Last point linked to what Giovanni just said, I think clearly there is an issue of scope of regulation. This is not, let's say, new. The discussion on shadow banking or non-bank financial intermediation, which is the new politically correct term, has been ongoing for some time. But of course, this is an important topic we should keep working on. And thanks again for the invitation.
Thank you, Mario. Last, Jorge.
Yes, thank you. On good policy, on looking to the chat and answering the questions, and very much related to what Barbara and Mario had said. This is a journey. This climate-related financial disclosures that are starting to be in place in different institutions is something that has already started and is going to change in the coming years. And the pace of that change is basically going to be related to the preferences of society as they become part of the objectives of governments and the regulation. So how can you check this? Many banks have already signed those climate-related financial disclosures and have issued documents as regard what it means for different banks. We have done that, so you can check it out in our website. Second point on something that I didn't talk much, but it was addressed. I think this competition with big techs and fintechs is something that will bring more innovation and that we should embrace. There is a regulatory challenge there, but I would invite the listeners to think in terms of going a little bit beyond the discussion of same activity, same regulation, because this is something impossible to conduct on different entities, on going to something that is same activity, safe regulation. So that will call for entity-based rules that might be different for different participants. So perhaps for big techs might be an issue of operational resilience, of competition, of how they use information from different parts of their chains to conduct businesses. But eventually, and this is my last point, very much agree with Mario here again, this is a client-based model, and the one that is going to best serve their customer, also including financial inclusion issues, financial health, environmental issue, are the ones that are going to be favored by clients. So this is business as usual in this regard. You need to be client-centered and focus very much on clients' needs.
Thank you very much all for this very, very interesting discussion. I think this will not end here. I see more questions from my colleagues about, for example, ethical banks, and Giovanni mentioned Islamic banks. So there are many descriptions for what banks can do. And I think we need to further the research and see how we can assess all of this. Before we close, I asked the team to prepare a survey. So I don't know if we can post it. Yes. Yes, if you can please answer to the poll. Can we move to the next question? So the majority of the respondents said low profitability. So this is a big issue that all of you mentioned, and I think it has been repeated also by everybody else. Also, after this, we are talking about financial instabilities. Probably this is the next risk that we are seeing. And then obviously other aspects related to conduct issues and external shocks. Thank you for this first question. We have the second question, right? Yes, more transparency is key for sure. And this is a very important factor for sustainability, more transparency on the banking side, on asset and liability. And this is extremely important also for banks in Europe, Mediterranean, and Africa. And of course, after this, social inclusion, green finances, and resilience. That's all. I would like to thank you very much for this very great discussion that we had. We will continue our series of webinars. The next webinar would be on the 25th of March on fragile states in the Mediterranean, in the Middle East and Africa. I would like to ask all the participants to switch on their cameras for the final group picture. And Jorge will let us know when the pictures are taken. I take this opportunity to thank very much the technical team for this very good realization and broadcasting. I thank all the panelists for the great discussion, all the EMEA team for the great preparation, and then all the participants who had the chance or had the, I would say, the patience to be with us for 2 hours. Thank you all, and I hope to see you next time on the 25th of March on the fragile states in the Middle East and Africa. Thank you very much and hope to see you soon. Bye-bye.